Hi, today we are going to talk about the basics of tax preparation. The basis for filing would be based upon the filing status. The filing status can be single, married filing jointly, married filing separately, head of household, qualifying widower with surviving spouse, and dependents. Dependents can be children and other dependents. Child tax credits can be claimed for children who are less than age of 17 years and younger. Filing status is single whose gross income is $12,950. Married filing jointly is $25,900 whose gross income is more less than 25,900 they don't have to file. Married filing separately $5 and above they need to file. Head of household status is 19,400 USD and qualifying widow is 25,900. Points to focus on in this presentation are the income items, adjustments to income, standard versus itemized deductions, tax liability calculation, determining refund or balance due. This is the form 1040 page 1 and page 2. We can go through the same. So in this what is the tax slab rate based on which the filing is done? So the slab rate is from 10% to 37%. 10% is 0 to $10,275. 12% is 10,000 to $41,075. So on and so forth. So we based on the filing status, we'll take whether it's for single filers or married filing jointly or married filing separately. So what are the line items? In line 1 we can see wages. Wages may be multiple W2s of taxpayer and spouse, and FII may be multiple states. It can be multiple state tax return or multiple other state returns. Line 2 can be interest income, mostly taxable. Municipal interest income not taxable. Savings bonds is taxable at federal level but not at state. Exception can be education expenses. Line 3 is dividends. Earnings increase from stock ownership is called dividends. Dividends can be of two types, ordinary and qualified. And line 4 is of IRA, which is individual retirement account. In this, the taxability will be upon withdrawal, which is the same as 401k accounts. Line 5 is pensions, wherein the taxability is based on employer-employer contributions, duration of payments. Line 6 is social security. It can be taxable if combined income in excess of certain amounts. Thresholds vary with filing status. Taxability maximum 85% social security received. If social security is the sole source of income, no filing requirement. Line 7 is capital gains or losses. All gains taxed. Losses capped at $3,000 per year. Adjustments to income. Schedule 1. Adjustments to income additions. Taxable refund, state refund. It can be alimony, business income, Schedule C, rental real estate, S corporation, partnership income. Unemployment compensation is taxable. Other income is gambling. In adjustments to income for deductions, it can be educator expenses up to $300, health savings account HSA, half of self-employment tax, penalty on early withdrawal savings, alimony paid prior to 2019. IRA deduction you contributed to your IRA. Student loan interest. Next is Schedule 1 additional income and adjustments to income. In additional income, you have tax refunds, alimony received, date of original divorce or separation agreement, business income or loss attached Schedule C, other gains or losses, rental real estate, royalties, partnerships, S corporations, trusts, etc., farm income or loss, unemployment compensation, other income, net operating loss, gambling, cancellation of debt, foreign earned income exclusion from Form 2555, Foreign income from Form 8853, income from Form 8889, Alaska Permanent Fund dividends, jury or duty pay, prizes and awards, activity not engaged in for part income, stock options, income from rental of property if engaged in rental, whether actively participating or materially participating in business. So adjustment in income can be educator expenses, certain business expenses of reservists, performing artists, and fee basis government officials. Health savings accounts deduction, moving expenses for members of armed forces, deductible part of self-employment tax, self-employed SAP simple and qualified plans, self-employed health insurance deduction, penalty on early withdrawals of savings, alimony paid, recipient's SSN, date of original divorce, standard deduction versus itemized deductions. Claiming the standard deduction is certainly easier. To itemize, you need to keep track of what you spent during the year on deductible expenses like out of pocket medical expenses and charitable donations. You also need to maintain supporting documentation such as receipts, bank statements, medical bills, acknowledgement letters from charitable organizations, and tax documents reporting the mortgage trust, real estate taxes, and state income taxes you pay during the year. Then you need to determine whether your available itemized deductions exceed the standard deduction for your filing status. That might sound like a lot of work, but it can pay off if your total itemized deductions are higher than the standard deduction. For 2022, the standard deduction numbers to beat are single taxpayers 12,950, married taxpayers filing a joint return 25,900, head of household is 19,400. Those are the numbers for most people, but some get even higher standard deduction. 1065 US return of partnership income and form schedule K1. For Form 1065 US Partnership Income, Form 1065 is a tax document issued by the IRS to declare profits, losses, deductions, and credits of a business partnership. In addition to Form 1065, partnerships must also submit a Schedule K1 prepared for each partner. Form 1065 is due to the IRS by the 15th day of the third month following the date the taxpayer ended for the business. If your business follows a calendar year, the due date is March 15th. Schedule K1 is an internal revenue service tax form issued annually to the individuals in business partnerships. The purpose of Schedule 1 K1 is to report each partner's share of the partnership's earnings, losses, deductions, and credits. It serves a similar purpose for tax reporting as one of the various forms 1099, which reports a dividend or interest income from securities or income from the sale of securities. While a partnership itself is generally not subject to income tax, individual partners, including limited partners, are liable to be taxed on their share of the partnership income, whether or not it is distributed. Form 1040 needs to be filed with the IRS by April 15th in most years. Everyone who earns the income over a certain threshold must file an income tax return with the IRS. Keep in mind that businesses have different forms to report their profits. Form 1040 is available on the IRS website and has two pages that must be filled out. Form 1040 can be mailed in or e-filed. Tax filers are asked for their filing status along with their personal information, such as their name, address, social security number. Some information on one spouse may also be needed, and the number of dependents. The form also asks about full year health coverage and whether the taxpayer wishes to contribute $3 to presidential campaign funds. The 1040 income section asks the filer to report wages, salary, taxable interest, capital gains, pension, social security benefits, and other types of incomes. The new tax legislation eliminated many deductions, including for unreimbursement employee expenses, tax preparation fees, and moving for a job except for military on active duty. The form uses what the IRS terms a building block approach and allows taxpayers to add only the schedules they need to their tax returns. Some individuals may need to file one or more of six new supplement schedules with their 1040 in addition to long standing schedules for items like business income or loss. This depends on whether they are claiming tax credits or owe additional taxes. Many individual taxpayers, however, only need to file a 1040 and no schedules. A K1 is also commonly issued to taxpayers who have invested in limited partnerships and some exchange traded funds, such as those that invest in commodities. In addition, a K1 is issued to shareholders of S corporations, companies with under 100 stockholders that are taxed as partnerships, estates and trusts that have distributed income to beneficiaries also issue and file Schedule K1s. Schedule K1 is an internal revenue tax form issued annually for an investor for an investment in a partnership. The purpose of Schedule K1 is to report each partner's share of the partnership's earnings, losses, deductions, and credits. Schedule K1 serves a similar purpose as Form 1099. A Schedule K1 is issued to taxpayers who have invested in limited partnerships and some exchange traded funds. There are also K1 forms for shareholders in S corporation and beneficiaries of estates or trusts.